In the past year, we've witnessed the Great Resignation, in which a new high for a mass exit from the workforce was set. The Great Reset Agenda by the World Economic Forum, which claims that by 2030, you'll own nothing yet be contented. And the Great Wealth Transfer, in which millennials are anticipated to inherit around $35 trillion. And now, we may be witnessing the greatest wealth transfer in history while everything is going to racks and ruins. Here's what we're dealing with. Markets have become bearish. Hundreds of equities are trading at all-time lows. The economy has begun to decline. Inflation has peaked in 40 years, and a recession is looming. However, most people are unaware that somewhere along all the bad news, there's an opportunity that is most likely one of the best out there to increase your fortune faster than ever. And this video will discuss just that. But before that, go ahead and click that like button. It helps the channel bring more people to our little bubble. While you're at it, click the bell icon to subscribe to this channel and stay on the loop with the latest videos on personal finance and investments. As established, the market hasn't particularly been in tip-top shape. Gone are the days of glee during the everything rally where everything went up, up, up at the height of the pandemic recovery in 2021. It has now triggered an everything sell-off where everything is going down, down, down. Why am I pointing this out? It's important to discuss the market's current disposition before talking about recession implications. And said disposition can be characterized by three factors. The first, obviously, is inflation, but not your ordinary inflation. Salaries climbed as demand surged, forcing businesses to swiftly increase their labor force to satisfy orders, and prices rose at such a rapid pace that we reached a new inflation high in 40 years. However, high inflation alone is not enough to cause an everything sell-off, but it does prompt an interest rate increase, which is the second factor. Rates have seen a 25 basis point or a 0.25% hike March of this year, and another 50 basis point or a 0.50% hike May of this year, which is the most in 22 years. Basically, what this means is that if rates were at 2.25% and the Fed raised them by 0.25% or 25 basis points, the new interest rate would be 2.50%. If that doesn't sound grim enough, the Fed is planning more hikes for the rest of the year. This causes stock market values to become less alluring, mortgages to set people back even more, businesses to pay extra for overhead costs, and ordinary individuals to have less discretionary money. Which leads to the third factor, instability. Right now, there's a concern that more companies could begin laying off their employees, even more than those recorded in the early stages of the pandemic. That, mixed with the scares of a stagflation, the uncertainty surrounding the Russia-Ukraine war, and the imminent rate hikes is a guaranteed formula for a market downturn, which is what we're seeing right now. First, there's the stock market, which recently hit its worst drop since 2020. Even if you go back just a little bit and look at figures from the beginning of 2022, it shows a considerable decrease. The S&P 500 is down over 19%. NASDAQ is down over 28%. And Dow Jones is down over 15%. The average retail prices for most portfolios are now 20% lower. Second, there's the crypto market where 40% of investors are reported to have gone under as prices decline up to more than 55% from their peak. Now, it's worth noting this because in the past few years, cryptocurrency has gained a reputation of being a hedge against inflation, a way to preserve value and guard against market volatility. But as we've seen this year, it's proven otherwise, and if anything, It's sharing the same trajectory as tech stocks, which are almost as volatile as cryptocurrencies. Third, there's the real estate market, which has seen the highest point increase in 30-year mortgages since 2009 due to the rate hikes imposed by the Fed. It's looking rosy for buyers though, as prices are projected to be cheap for the first time in a long while, with inventory being saturated with improved listings and sales. Realtors are starting to lower asking prices, and several cities are seeing a dip. So if you've been considering getting into real estate, then you should be on the lookout. With that in mind, when you see massive declines in the markets, it's important to look at them objectively to see what's realistically going to happen and avoid panic. If we study past bear markets, we could say that a huge opportunity is knocking at your door right at this moment. The average bear market lasts approximately 1.4 years, and the average dip is 41%. While that is considered the rule, there's always going to be an exception. In 2020, for example, the market dipped 34% in a span of just 1 month, the shortest bear market ever in history. Years before that, the market dipped 56% throughout the Great Recession that ended in 2009. The same oddity occurred when the dot-com bubble burst in 2000, where tech stocks lost about 78% of their value. We also have the 60s and the 70s decline that saw a dip of 36% and 48% respectively. Now, if you look at the bull markets that follow right after, you can see that the average duration is an astounding 9 years, and the average return is approximately 480%. But just like with the bear markets, there's always going to be an exception, so you shouldn't expect it to consistently be this long. Nonetheless, bull markets tend to last longer than bear markets in general. How is this an opportunity for you? Well, these figures show a pattern where recessions are always followed by a recovery that includes a strong rally in the market. It's telling you that recessions are a good time to invest because you're buying while everything is at an all-time low. And although uncertain of whether it will stop dipping or when it will start to rise, you can expect a return sometime in the future when markets start going bullish again. So what can you do to make the most of a recession? First, you can profit from a market decline by dollar cost averaging, which is making regular incremental investments over time rather than a single large investment, so your cost basis is always lower than the price. This is a good strategy, especially for investors with low risk tolerance. Second, invest in core sector stocks. In a recession, consumer staples such as healthcare, food, and drugs are the last to be cut from household budgets. They are, therefore, sometimes called defensive stocks. They tend to be resilient even during economic crisis. Some examples of these companies are Procter & Gamble, Johnson & Johnson, Walmart, and Costco. Third, buy into dividend stocks through mutual funds or ETFs that invest strictly in dividend-paying companies that have been consistently paying dividends and strong track records. These companies fare better in downturns better than other companies with poor cash flows, so you are sure to receive returns even when share prices drop. Fourth, consider buying real estate properties. As mentioned earlier, property values drop during a recession and opens a buying opportunity for realtors. You can rent your property out to a reliable tenant while waiting for a recovery. As soon as the market recovers, you can sell your property for a profit. The point is, based on history and previous recessions, you should not be panicking at this time. Instead, you should buy in now. Now is the chance for you to make more money in a shorter period. Any dip in the market is a boon as an investor like you. Though no one is certain when the market will recover, one thing is for sure. You will not be one of those who will look back and regret not buying in this time. Enjoyed this video? Leave a comment down below and click the bell icon to be the first to know when new videos on personal finance and investments go up. Go ahead and give this video a like too. It helps the channel a lot. Thanks for watching, and until the next video.